Hello and welcome. I'm Harsh Sahita. With me is Sudipta Roy, Managing Director and CEO at L&T Finance. Good morning, sir. I want to first start off on the Q1 FY26 numbers with regard to your credit cost number. It's coming at 3.4%. The guidance was 2.3 to 2.5 with an improvement in H2 FY. Do you still stick to that guidance, sir? Give us the perspective on what's happening and whether that guidance still stands.
Yeah, good morning. I think the reason the credit costs have inched upwards is primarily because of the flows from the microfinance business, and the credit cost after using the macroprudential provisions has been about 2.23%. If I look at before macro, obviously it's at 3.4%. And as you are aware, the microfinance sort of asset quality industry cycle has continued for some time. And we were expecting a gradual resolution in Q1 of this year. However, as you are aware that in Q4 of FY25, in the month of February, there was a ordinance in Karnataka. And Karnataka is a large state for us in terms of our AUMs. We have about 3,500 crores of book in Karnataka. We saw a sort of erosion of collection efficiencies in February after the enactment of the ordinance, and that market has taken time to stabilize. So overall, we saw some sort of flows from that particular line of business sort of book as well, and which has sort of taken, and overall, because of that, the overall microfinance industry as well as our microfinance book sort of collection efficiencies has taken a little more time to stabilize than what we would have originally liked. I do believe that the positive trends in collection efficiencies will continue. Our overall collection efficiencies at the end of Q1 FY25, for the country remained at about 99.34%, and I see this trending upwards. And as this will trend upwards, I do believe that in H2, it will settle down and move towards normalcy at about 99.6% to between 99.6 to 99.7% collection efficiency. All the other lines of business, just like, in last year, we saw some asset quality issues on the margin in the two-wheeler business, and that has reasonably settled. Our two-wheeler business is performing very well. Our new AI credit engine, which was deployed in the two-wheeler business last year and has been almost now 12 months in operation, has performed very well. The gross non-starters and the net stored non-starters have been almost sort of significantly lower than what was there last year, and obviously our prime share of our sourcing has gone to almost 24%. So overall, the asset quality directionally is going through a significant improvement, and I do believe that we will see a much more normalized credit cost regime towards the latter half of the year, especially in Q4.
Okay. Sorry, sir, I just want to take a step back here. You've given us a detailed explanation. Give us a perspective. So does this credit cost of around 2.3%, excluding the macro provision which you've utilized, does that continue for all 4 quarters? And does the 2.4 to 2.5% credit cost guidance given in Q4 account for macro provisions as well, or does it exclude macro provisions? Just give us that perspective.
So, we are hopeful that around Q4 of this year, we should trend towards that credit cost guidance. Obviously, as I said, because of the Karnataka ordinance, there have been some additional flows which have come, which were not factored into the original guidance because, it happened over a matter of 1 month, the entire ordinance in action. And so I do believe that the corridor of guidance which we had given, will be more possible in Q4. So that is what our guidance will be. And obviously in Q4, we do not intend to use any macroprudential provisions. As a a company, our focus is to be as prudent as possible and not to use macroprudential provisions as far as possible. However, given the fact that there were certain conditions precedent which entailed use of the macroprudential provisions, we have used the same on guidance of the board and on approval of our auditors.
Fully understood, sir. So sir, the 2.5% credit cost guidance stands and will likely be your exit credit cost number in Q4 FY26. Is my understanding correct?
That will be our endeavor.
Got it.